All right, hello and welcome everybody. And today we're going to be covering off on the accounting equation, which is one of the fundamental building blocks in accounting that we'll build off of in future lectures. So let's go ahead and just dive right into it. The accounting equation states that assets equals liabilities plus equity. And in order to make sense of this equation, we have to break down those three terms and what they mean. So assets represent anything of value that has a future benefit to the business. So some of the common assets that we'll see come up are things like cash, land, buildings, and equipment. The next term is liabilities. And when you hear liabilities, I want you to think debt or some other future obligation. Liabilities represent debts or obligations that we owe in the future. And the last term is equity. When you hear equity, I want you to think ownership. Equity represents an ownership stake in the assets. So let's dive into a few examples to give a bit more detail about these. So in this first example, let's say we have Sarah, and Sarah buys a pencil with $1 of her own money. So let's start by pulling up our accounting equation and see how this scenario plays out. So the first thing we need to ask ourselves is, what is the value of the asset in question? In this case, the pencil is worth $1, so that means that Sarah has $1 worth of assets in her possession. The next thing we'll ask is about liabilities. How much does Sarah owe on this pencil in the future? Since she already paid for it with her own money, she doesn't owe any money on it in the future, which means she has 100% equity in that pencil. So in this example, her liabilities are not worth anything, it's $0, and she has $1 worth of equity in the pencil. Notice that the assets equal the liabilities plus equity. That always has to hold true in these different examples we're going to go through. So the next example is a little bit more complex. Let's say we've got Keith, and Keith wants to buy a house. So he buys a $100,000 house, and he puts $10,000 of his own money down for a down payment and takes out a mortgage worth $90,000 for the remaining value of the house. So let's pull up our equation. And again, the first thing that we want to ask is, what's the value of the assets in question? In this example, the house is worth $100,000. So Keith has a $100,000 house in his possession or in his control. The next thing we want to know is liabilities. How much does Keith owe on this house in the future? Since Keith took out a $90,000 mortgage, that means that he owes a bank $90,000 in the future. So that's his liability. And the last part is equity. Again, the ownership stake that Keith has in the house. Since he put $10,000 worth of his own money into this house, that means that Keith has $10,000 worth of equity in the house. Now, those first two examples were tied to individuals' personal lives. But in the accounting world, we're really going to see how this translates for businesses. So now let's say that we've got Acme Corp, and Acme Corp wants to buy a new office building for their headquarters. And this new building is worth $1 million. Acme Corp is going to put $100,000 of their own money down, and they're going to take out a $900,000 loan to fund the rest of the building. So again, we'll pull up our accounting equation. And the first thing again that we want to ask ourselves is, what's the value of the assets in question? In this case, the building is worth $1 million, so that's the value of our assets. The next thing is liabilities. What do we owe in the future on this asset? In this case, we owe $900,000 in the future, and we've put $100,000 of our own money down on the building, which represents our equity or our ownership in that office building. So our equity is going to be equal to $100,000. Thanks for joining today. For more information and more examples, feel free to visit us at easyaccounting.com. Thank you.